All right. So thank you for the introduction, and thank you all for having me. I I'm also a bit under the weather, so if I sound a little off, I apologize. But definitely happy to be here today with everybody. So as Kai mentioned, the topic today is understanding equity as part of a compensation package. So who am I? Well, I'm not an equity expert. I'm not a tax expert, and I'm definitely not a creator of engaging slides. So you'll kind of have to bear with me on the slides, but hopefully the information will make up for the lack of visual appeal. As Kai mentioned, I have I put 10 years here, but I do actually have over 12 years of experience, and I've made hundreds of offers with equity as a component of the offer. So hopefully can bring a little value to this topic. So why do these say sort of covered, even less covered, not covered? Well, equity is pretty complex. It's you start to read a little bit about one component and you can go down a rabbit hole, another component, another rabbit hole. So I wouldn't consider any of these areas 100% fully covered, but try to do my best today to at least hit on what are the different types of equity, what questions should you be asking. Less covered would be the equity components such as stock purchase program or performance stock units, how to evaluate the equity portion of your offer, because one, again, that's pretty complex, and two, everybody would have a different opinion on that, and there's lots of articles out there that you can read. um, I certainly have my own bias, so we'll kind of touch on it but not dive too deep. And then of course likelihood of an exit is sort of similar in the sense that everybody's going to have a different opinion on the likelihood of an exit. I think it's important to address it because, especially for stock options, if there's no exit, then there's no value to those options. And an exit can be going public or it can be getting acquired. So have to touch on it, but not going to try to cover it in complete detail. And then not covered at all is, should you cash out your restricted stock units or options, option dilution, or tax implications? Because again, just too complex. Definitely would want to do your own research, form your own opinions. So not trying to cover that in detail at all today. So types of equity. So what you have are stock options, which generally are coming from a non-public company. You have a set strike price, you have a vesting schedule, and you can purchase those options when they're vested. And I'll come back to these things and explain them a little bit more in detail, but important to note that with options, you do actually need to purchase those options. Restricted stock units are generally coming from a public company. There's no strike price. I mean, you'll know the price of the option, that you'll know the option value that option has on the market when you're joining that company, but you will not exercise your option at that exact value. The stock may go up, the stock may go down. So there's no set strike price. And then vesting schedule, and it is yours once vested. You do not have to purchase like you do have to with an option. And then less common, employee purchase plan and performance units. The idea behind an employee purchase plan is that maybe you're at a company where they're not giving out options, but you can purchase options. So generally you can do that, and you'd want to, obviously talk to the finance team, the HR team there. You can do that at a discount on the option and with some tax advantages. Performance units, these are, if you think of typical RSUs as being vested over a set period of time, so you're earning, say, 25% of your RSUs after your first year, you could call that time-based options. Performance RSUs or performance units are really just awarded by company performance. So you will see, some options if company hits X amount of revenue, for example. So talking specifically about RSUs, again, restricted stock units. So these are, generally public company. It's already on the market. There's already, clear value. You can trade it, buy, sell. One, you're going to want to know what the vesting schedule looks like. Different companies have different vesting schedules. So, my company, which is not a a public company, we have options. But just to give you a sense of our vesting schedule, it's 25% after the first year, and then it continues to vest every month until you're fully vested at the end of 4 years. At least when I was at Amazon, this was quite some time ago. Amazon, I think, was like 5% vest in the first year, then 15% vest in the second year, and then you start vesting every month, if I recall. So, definitely you're going to want to ask about the vesting schedule to know, how many of these RSUs are you actually seeing in your first year, second year, so on. What level is reflected by this number of RSUs? And when I'm talking about level, and I'll get to this again in a bit, one nice thing, and I should have called this out earlier, one nice thing about all of this is that, there's a lot more pay transparency these days, and that's great, and it's getting even better. That means that there's a lot of resources out there now, for example, Levels FYI, that break down various public companies, the levels at those companies, and how many RSUs or percentage of a compensation package is created by RSUs, depending on which level, right? And that can be levels for a variety of positions. You can have, level 1 through 7 for account executive, level 1 through 7 for software engineer. So when I talk about asking, what level is reflected by this number of RSUs, they should be already talking to you about what level they're considering bringing you in at. But if they haven't, you can kind of get an idea by saying, hey, if you're giving me this percent of RSUs of my compensation package, is that a level 3, level 5, so on. Are additional RSUs part of your employee retention strategy? That's just finding out if you're going to see more options along the way. A refresher means they're going to give you more options, at different points in time to try to keep you past that initial vesting schedule. So they'll give you more options. Let's say at the end of the first year, those options will have a 4-year vest. So now they're figuring, okay, hopefully we'll have this employee for the first 4 years on their first vesting schedule, and then an additional year because we've added these additional options. Promotion options, of course, you go up in level. Hopefully you see more options that are reflective of that level. Will you issue more RSUs if your stock drops significantly? The reason I'm chuckling, obviously, the market being what it has been the last, 3 months, 6 months, tech stocks are taking a hit. And so this is a huge question to ask is, what are you going to do? I think I was looking at Amazon again, like they had a 50% drop off they're not year to date, but within the last year. So you should be asking the company, okay, if you're basing part of my compensation package on the value of these options, what if the value of these options takes a big hit? I mean, there's still going to be some value. You're still going to be able to cash out at some value, which is it is different to the risk of stock options where you may not get anything. But at the end of the day, if they're trying to compensate you 30% of your offer in RSUs, if there's a big hit to that stock price, then you would want to understand what they're going to do, if they're going to up your salary at the annual review, if they're going to issue you more stock to make you whole. So important question to ask. And then of course, in case of acquisition, is there an accelerated vest? So this means you're already at a public company, but what if they get acquired by another company? Will the remaining options that haven't vested yet, will they accelerate? Oftentimes the answer is no, but it doesn't hurt to ask. It doesn't hurt to understand what the plan would be. Sometimes the answer is yes, or sometimes you can negotiate the answer to being yes. So good question to ask there. And then stock options. So of course, again, vesting schedule, understanding how long you need to be there to start to see different percentage of your options be available to you to purchase. What is the current share price? What is the strike price? And I'll come back to these in a second. So current share price, strike price, current company valuation, how many basis points is reflected by this number of options? Are additional options part of your employee retention strategy? How long is the exercise window? And in case of an exit, is there an accelerated vest? So coming back to the beginning of that, vesting schedule we talked about a little bit. The current share price, that is going to be what an investor is willing to pay for that stock option. So you can take that, and then you can take the strike price, which is set by the most recent 409A evaluation. That's saying if this option was on the market now, what would be the price that we would set it at? And then you can start to figure out how valuable is your option. So if your strike price is $1 and the current share price, which is again what an investor would be willing to pay for that if it was on the market, is $6, well, then you are actually already $5 in the positive should there be an exit event, right? Because your strike price is $1, share price is $6, $5 positive. Give me 1 second. Now, current company valuation is important because that's how you're going to be able to figure out essentially what percent of the company you have in terms of options, right? So, and that factors in later in negotiating and starting to understand what is a fair ask in terms of number of options based on the stage of the company and your level within that company and whatnot. So let's say maybe they'll just tell you right off the bat how many basis points. And a basis point is, I didn't have the right view. I meant to have my notes view up here, but it is, I think, 0.01 of a percent is a basis point. So you think of all the options that exist for this company, the options pool as being 100%, a basis point of that is 0.01 of a percent. So to figure out, how many basis points you're getting when you're getting your options award as part of your compensation package, you can take the share price minus the strike price divided by the current valuation of the company, and you'll be able to actually see how many basis points you're getting, even if they won't tell you. So, for example, going back to our original numbers, let's say the share price is $6, the strike price is $1, you have $5. Let's say the company is being valued at, did I get that right? Hold on, let me try a different view here. I'm gonna see if I can put it in presenter view. There we go. All right, now we'll actually be able to give you the exact numbers. So that makes more sense. So the way to actually calculate the basis points is the number of options you've been given times the share price divided by the valuation of the company. There we go. So let's say a company gives you 6,000 options. The share price, so this is not talking about the strike price. So the share price is $5. So 6,000 options times $5, you've got 30,000 divided by a company valuation of 3 million, you essentially have 1 basis point of that entire options pool. And we can come back to that if that doesn't make sense. And then the rest of these topics I think are pretty self-explanatory. So again, part of the retention strategy, the exercise window. So the exercise window, that is, let's say you have been there 2 years, you have earned 50% of your overall options package, 50% has vested, and you leave the company, you have a certain amount of time to purchase those options. And that's important to know, because if you don't know that and the window is short, and I think it can be sometimes as short as 30 days, then you will actually miss out on those options. Sometimes a company can have up to 10-year window. So definitely ask, how long do you have to exercise on these options? What is the exercise window? All right, so looking at evaluating different equity offers. So here you have, options and RSUs. So for the options, the question would be, is this a fair amount, and is the upside worth the risk? And again, I think you're going to get a lot of opinions on that. Again, I certainly have my own bias. So you need to form your own opinion on that. I was reading in an article a couple of days ago that, you're generally never joining a startup from a pure financial decision. You're joining a startup for the experience that you'll get from that, potentially broader scope, whatnot. But from a financial angle, it's generally not going to add up, and I can get to the data as to why that is. But you're still going to want to know, is there a lot of upside coming from this? Given the risk that I may not actually see any upside. And is it a fair amount of options? So things to consider for that would be, what is the stage of the company? Is it a seed stage company where you likely have angel investors and friends, family? Angel investors usually defined as someone that has a lot of money. They're just an individual investor. You can think of Shark Tank and what those individuals are doing as someone like that. Whereas venture capital, they're coming actually from a company where they're taking other people's money that's pulled together and investing it. So stage of the company, seed stage, Series A, which is when some VCs start to come in, Series B, which is still considered early stage, although you've probably got your product on the market and there's some validation for it. C and D, where you're talking kind of growth and maturity. So the risk at those various stages definitely changes. And again, I'll touch on that in the next slide, but you're going to want to see a lot more potential upside given the risk the earlier you're coming in. So stage of the company, if you're talking seed stage, you're probably wanting to see full percentage points of equity. I think I was reading something where a non-founding CEO is getting something like 5 to 7% in equity of that company. Obviously, this changes to just a few, maybe 1 basis point, maybe half a basis point, depending on your role and level. The farther you go along, because obviously there's less risk. So again, earlier on, and I can touch on something that's a good resource for this to know what the market looks like for this right now. But earlier on, full percentage points to a couple basis points for maybe Series A to a basis point or less than a basis point the farther you go along. Again, obviously it depends on your role and your level. Most recent valuation. And I would say this is important to know because you want to know what potential upside looks like, right? So if you know that your current value of an option is, again, let's take the previous example where the share price is $6, the strike price is $1. So each option you have is already worth $5. But what does that mean in potential upside? And so you want to start to see, like, based on when I'm coming into this company, how much is this likely to grow? So if you're coming in, and these are general numbers, and again, you'll find different numbers depending on different resources, but generally speaking, the earlier investment is coming in, they're expecting to see 20x in valuation growth because they're expecting to see 20x of their investment. Middle to, you can call it middle stages, growth stages, it's about 10x. And then more mature company, if an investor comes in, they're expecting to see about 5x. So let's say, you're coming in and you've got that $5 for each share of value. You've got 6,000 options. That's 30,000. And you're coming in around the time, like Series A, well, more like Series B, Series C, when they're expecting, 10x of their investment. Okay, so then, potential upside of this, and again, it's all hypothetical, it can fluctuate, but potential exit of this would be about 10x that 30,000. So your upside looks like 300,000, and hopefully that makes sense. We can come back to that again if necessary. And then likelihood of an exit, obviously, again, if there's no exit, the options have zero value. So let's touch on that in a second. With RSUs, really comes down to, is this a fair amount of RSUs? Again, that can be based on the level and not only the level, but the role and that you're coming in, whether it's software engineer, sales development representative, the level you're coming in as, what is the overall percent of the offer that is being comprised of RSUs, and then, of course, taking a look at stock sector market performance. If you're coming into this company and the whole sector has been growing at 10% year over year, you can start to say, okay, well, obviously the market can fluctuate, but I have faith that my RSU value will grow something roughly 10% a year over the next 4 years, which is a typical vesting schedule or vesting time limit. We'll come to this resource in a second, but important to note that, again, compensation, transparency, pay transparency, you now have levels FYI, which has got hundreds of public companies breaking down the different roles, the different levels, and what percent of the offer package is comprised of RSUs for those individuals. So very useful resource. Now, again, likelihood of an exit. This is it's not to meant. This is not meant to bias anyone away from going to startups and taking that shot on startups. Again, there's other value to it. The value to grow, be part of growing a company, the value of what you can learn there. So this is not to discourage, but it is important to note that you really do want to see significant upside because there is significant risk. 9 out of 10 startups will fail, and this is not tech sector specific, or even you'd want to go farther than tech sector. You'd want to say difference between SaaS companies or platform as a service companies. If you go in farther and say speech tech companies, right? You could go even farther in research and find out what the rates of success are. So this is broadly speaking, but 9 out of 10 startups will fail. 60% of startups fail between pre-seed and Series A, 35% between Series A, trying to reach Series B. And then after Series C, startups actually have a high chance of an exit. The failure rate is roughly 1%. So that's why if you come in as a Series C, you're taking a lot less risk. You're going to see, probably less than a basis point of equity, but you've got a much higher likelihood of seeing value from that equity. And then resources, I looked at Carta, Harvard Business Review, Investopedia, Levels FYI, all these various links. I believe this is not only recorded, but probably available to everybody. So hopefully there'll be future access to these links. And I will stop there for questions.